All right, so let's get on with our today's session. So welcome everyone. This is our bootcamp session number 12 of our options bootcamp. Now this is the 12th week. We've been meeting each other and talking about options, mostly about the concepts behind options. So today we're going to talk about option Greeks. This is a session split into two. In a previous session, we talked about one of the Greeks, which was delta. Today, we're going to talk about theta, vega, and gamma, all the remaining three options. There are more, but I generally focus as a retail investor. It's enough for us to focus on delta, theta, vega, and gamma. So today, I will focus on the remaining three. As always, anything that we discuss in these meetings is just for our education. It's not an investment or a financial advice. So let's keep it like that. In our previous drills, we have already done with a beginner level. We're already finished with an intermediate level. Now we are getting to the end of these bootcamp sessions, or we're number session 12. We are on learning about option Greeks. 2 more sessions to go. I would say maybe 1 more session to go where we talk about the basics of options and how to use options in our investment portfolio, which will be hedging. I think that's one topic which I see a lot of people interested in, because I started my journey in options when I was trying to figure out how do I hedge my portfolio if market goes against us. Buying stocks, buying ETF, it means we are long on market. Our portfolio benefits if the market goes higher. But we don't know where market could go. It doesn't always go higher. We don't have to remind ourselves what happened last year in March. And doesn't always go low also, what happened after March. So most of the time we are concerned with what happens if the stock goes down, market goes down. That's where I started exploring how to hedge my portfolio and came across options. So we will talk about that in our next session, is how to use options to hedge your portfolio. And the final session will be mostly AMA. Maybe if you have still questions left around your options, there are some nagging thoughts you have, you want to clarify, we'll discuss that. We'll also talk about some useful tips and tricks which are not mentioned in any book, but I found those useful while I was trying to do options as my side business along with my full-time job. So there are tips and tricks that worked for me. I would like to share that in our last session. If you have missed previous sessions, or if you're joining here because you're joining it for the first time, you can go and get access to all the recording of all the previous sessions on the website, optiongig.com. Register as a user by clicking on the sign up button. After sign up, go to members and bootcamp. Good thing is it is available for free, so you don't have to pay anything, but you will get access to all these bootcamp videos. Even if you want to go and refresh your concepts, these videos are there. Join as a member, click on a bootcamp, and yeah, we have the latest video up there, 11th session. Generally by end of Thursday, I'll have this uploaded. So today's session will be available in another couple of days on the website, in which we're going to talk about theta, vega, and gamma. Before that, any questions if you have, do let me know. Throw it in the Q&A panel or in the chat box. Okay. No questions? So let's start with the first one, which is theta. But before that, a quick recap of why we even started talking about Greeks. So we learned in drill number 8 that the option pricing, any options price has 2 components, intrinsic value and extrinsic value or time value. And those intrinsic and extrinsic are determined by various factors. A spot price or the stock current price, and the strike price. The relationship of these two determines what's the intrinsic value in portion of an option pricing is. Remaining everything else is an extrinsic value or time value. So for example, if I bought a put at a strike price of 50 and the stock is now trading at 45, and that put option is currently worth $6. In that case, the intrinsic value is 50 subtract 45, $5 is the intrinsic value. $1 is an extrinsic value or time value. Now that time value is determined by how many days are remaining for maturity, what's the volatility of the stock, and what's the rate of interest. Now, to understand how these factors are impacted, we look at option Greeks. So we already talked about option Greek delta, because delta will change the intrinsic value, will tell us how the intrinsic value of an option will change. Today, we're going to look at theta and vega, which will tell us how the extrinsic portion of option pricing changes. Then we will also look at gamma in the end, which tells us what we need to be careful about in our option trades. I'm not going to talk about rho, which tells us about the rate of interest, because generally rate of interest doesn't change on few weeks basis. So, and as a retail investor, I never have to worry about rho too much. So I'll skip rho for today's session. But if you have a questions on rho, or if you really want to know about rho, just ping me and maybe I can send you some material on rho or point you out to some more literature on rho. But I didn't have to use it for my trading, so I'll skip that one. So let's talk about first one, which is theta. Delta, which we talked about in previous session, was most important because it tells us the risk. Second order of importance as a retail investor for me is theta. And let's understand what theta is. Again, this is the first order Greek. If we look at the math behind this, option pricing is determined by the Black-Scholes model, in which, among other factors, there is a time to maturity is one of the factors. So theta is a first order, means you take a derivative of that and come with based on with respect to time, and that's where you arrive at theta. That's the math I'm going to talk about today. Okay. So now, from a day-to-day understanding perspective, theta is a rate at which the option's extrinsic value will decay every single day. Because options have a finite lifetime. Unlike stocks, if I hold a stock will exist, as long as the company exists, or as long as the company is listed on an exchange. Not with an options. Options have an expiry time. And as it gets closer and closer to that expiration time, the value, the extrinsic value of the option starts to decrease. And that decrease is determined by theta. So for example, if an option is worth $50 today, means if you have to buy this option, you have to pay $150. And the theta of this option is negative 0.1. If the rest of the world comes to stand still, this option will be worth $0.40 tomorrow. Now, how do we use it for our trading purposes? Again, the whole idea we're talking about these Greeks is, first of all, let's understand what this is. Then we'll understand how do we use this to make our decisions in trading. Or otherwise, what's the point of learning this if we can't use this in decision making? Other thing to notice, this is negative for both puts and calls. Whether you buy a put or you buy a call, the extrinsic value will continue to go down every day. This theta is a hole in this bucket, which will drain the value of an option slowly. It will happen every day. Theta won't come out just on one particular day, but everyday basis, your option will continue to lose value because of theta. There could be other reasons why it will increase in value. But if you have to look at the impact just of theta, your options will every day lose value because of theta. The loss in the value is not constant. It is not linear. So if you have an option which is expiring 120 days later, and I have an option of the same stock at the same strike price, but that is expiring 30 days later, the theta decay in both these options are different. The option that you hold, which is 120 days out, is decaying at a slower rate than the option that I hold, which is only 30 days out. The rate of decay for 30 days is faster. And we'll tie everything together in terms of why, how to make use of theta for our decisions. Like I said, theta always have a negative impact if you are buying an option. If you're buying an option, you are fighting against theta. The reason why we buy anything so that we can sell it at a higher price later on. But now there is one factor which is decreasing the price of options, which is theta. So if you are buying options, you really have to overcome the impact of theta. But if you are selling an option, then theta has got a positive impact on your portfolio. Because I sold something at $1.50 today, and I know that 2 days later, it will be available at $1.30. So that's my 20 cents of profit. So for short options or for option sellers, theta is good. For option buyers, theta is a bar that the trade needs to jump over to make any profits. The option buyers have to pay the cost of theta for having unlimited upside. So if you go and buy a call, you got unlimited upside. The stock can go to infinity, but then you have to battle with the theta because that will, if stock doesn't move, your option will continue to decrease in value, even if the stock doesn't move at all. One big reason why your option will continue to decrease in value is theta. So if you buy option, you better make sure that your direction, or the stock will move in a direction pretty quickly. Otherwise, your option will start to lose value because of theta. But this is a friend of option sellers. Because if we sell option and the value decreases, we can buy it back later at a lower cost. Now let's look at how about the moneyness. Slightly in the money or at the money have higher theta. So if a stock is trading at 50, the strike price is around 50 will have a higher theta. The strike prices which are way away from 50, it could be less than 50 or it could be higher than 50. It could be in the money or out of money. That will have a smaller theta value. So if you're selling option and you want to get a quick benefit of theta decay, you get closer and closer to at the money. But if you get closer to at the money, as we looked into previous session, your delta is also higher. So you also have a higher risk. Again, in markets, there is no free lunch. There is no reward without taking higher risk. So if you're selling at the money options, you are taking higher risk because the delta is higher. And for us, option seller, theta is kind of our daily wage. So if I look at my portfolio and I know what a theta value is, so I have some idea of, how much is my portfolio. If I'm mostly option seller, then I have some idea of how much these portfolio is making on per day basis just because of theta. There will be other factors which will negate that impact. But looking at a theta, give me some idea of, how much can I retain? And as you do more and more options, we'll figure out that maybe if you have sold options which has got 100 thetas worth of options that you have sold, you might be able to retain and make a profit of only 25 thetas. So kind of a 25% of the theta that you have sold. So looking at a theta, we can figure out, okay, how much maybe on a daily basis is my portfolio could be making. Now, when it comes to option buyer, if you want to avoid a theta decay, you either buy deep in the money or deep out of money options. Now, this is where when we talk about leaps, I prefer buying deep in the money option because leap is my substitution. Leap strategy is my substitution for stock. So in that case, if I buy at the money option, at the money long call, I have a huge theta working against me. And anyway, I'm using that leap option to substitute a stock holding, which is anyway high delta. So I would want to go and buy deep in the money option so that I'm not paying much for this theta premium. But if you go deep in the money to avoid paying for theta, you also get higher delta. But like I said, for leap options, I'm okay to have a high delta. And that is why I prefer going deep in the money for leap options. But if you, for your, let's say if you're doing a regular options and you are kind of buying a call, if you want to avoid theta, you go out of money because it is cheap. Out of money options are way cheaper. Those lottery tickets, those won't have a daily decay. It won't have a higher daily decay, but it is a very less delta. So if stock moves in a direction, your option won't move much. Again, there's a risk and the reward. If you're avoiding the decay of your options by buying out of money, then you won't get a huge benefit if the stock moves in your direction immediately. So you have to decide what's appropriate for you from your trading perspective. Do you want to go deep in the money? Do you want to sell options? Which means if you're selling options, then theta is working for you. But then if you're selling option, you got a higher risk as well. You need to learn how to manage the risk. So going back to this chart, now generally people ask me at what days to expiration I sell option. I sell option around 45 days to expiration. And this is the reason why I like to sell options around 45 days to expiration. Because as an option seller, I want the theta to decay fast. So that if I sell option now, and if theta decays, stock hasn't moved much, and theta decays, my trade become profitable, I can buy back and close it. So, but if I sell it at 120 days, the theta decay is very less. Then I'm only dependent on stock movement to make any money in this trade. But if I'm doing close to 45, the theta decay starts to accelerate. Now, theta will be helping me at a much higher rate when I'm getting closer to 45 days. Then you could ask me another question, then why not sell weekly? Theta will be fastest in the weekly in the weekly expiration because it's very close to expiration. So we'll talk about that in the end when we discuss gamma. So this is one reason why I would like to sell options which is expiring, 60 days. 45 is not, for me, it's not very hard criteria. I'll sell it at 60 days. I'll sell it at 45 days, 30 days. Because this is the area where we have a lot more decay happening for me as an option seller. Let's look at any questions on theta before I jump on to the next one, which is Vega. All right, let's look at the next Greek, which is Vega. So in order of importance, delta was I would say, the most important Greek for us as a retail investor or trader. Next one I focus is on theta. Delta tells me risk. Theta tells me what do I make, not based on where the stock is going to move, but just because of time. The third one is Vega. What does Vega tell us? This is again like delta, like theta. This is a first order Greek. I'm not going to talk more math beyond this one, but this tells us how much an option value changes when the implied volatility changes by 1%. Delta tells us how much the option value changes if the stock moves up by $1. Theta tells us how much the option extrinsic premium decays by 1 day, getting 1 day closer to expiration. Vega tells us how the option pricing changes with the implied volatility changes by 1%. So now, most of the retail investors generally focus on direction when they're trading options, right? If you are bullish, you buy call, because if the stock goes higher, your call will benefit. If you're bearish, you buy put. But if you go back and look at the history, most of the money is made in if you're selling option. But then when you're selling option, you also have to consider a lot of other things. Even though when you're buying option, you also have to consider volatility. But I see many retail investors don't know much about volatility. But hopefully after this session, you'll get some idea about volatility and include that in your decision-making process. So Vega tells us the impact of volatility on our option pricing. Higher the volatility, higher is the option price. So this goes back to Black-Scholes formula, where if your implied volatility is higher, the option pricing is higher. And doesn't matter whether you're buying or selling puts or calls. If IV goes up by 1%, the option pricing will also go up. By how much will it go up? That Vega will tell us. But whether it's call or whether it is put, the option pricing for both calls and puts will go high if implied volatility goes high. So, like I said, both long puts as well long calls have a positive Vega, because if IV or implied volatilities go up, option pricing go up, irrespective of whether it's call or a put. So if you're bought calls, you want volatility to go higher, because it means the call that you bought, will now increase in value, and then you can sell that call at a higher value. Same is the case if you bought a put. If you bought a put, assuming stock doesn't move, nothing happens. But if you bought a put and the volatility increases, in that case, your put will also increase in value. So option buyers will benefit if the implied volatility increases after you have entered your trade or you have bought your option. Option sellers will have the other side of this trade, because both short calls, if I'm a seller, then either I'm selling call or put. So it's a short call or a short put position. Both of them have negative vega, means if the implied volatility increases, the short calls and the short puts, they decrease in value. So option sellers benefit if the implied volatility decreases, then the short call and short put both, because the calls and the puts, they both will decrease in value. So if I'm a short on the calls and puts, that's good for me. So as an option seller, I'll benefit if the implied volatility actually goes lower after I've entered the trade. Now I'm reminded of an interesting phenomena which told us you generally don't see a huge impact of implied volatility in, let's say, unless the market has really crashed or has really gone high, which generally doesn't happen, except a few instances. But now in some particular stocks, we have seen this phenomena of IV going through the roof, implied volatility going through the roof. And, there were a lot of questions on how the options have behaved. Some examples of AMC, and mostly it's around the meme stocks. You've seen, in case of, let's say, AMCs, there are cases in which if you have sold a put option on AMC because you think this is going to go higher and will benefit if we have sold a put option, stock goes higher, this is a bullish move and my put option should be profitable, we'll be able to close it. What happens in, let's say, AMC or GME is you sold a put option, stock has gone higher, but your put option has not decreased in value, even though the stock has gone higher. The reason is in some of these meme stocks, even though the stock has gone higher, the implied volatility also jumped up by 20%, 30%. So all the stock movement, all the benefit of the stock movement was just negated by the increase in implied volatility. And then I'm checking foreign force asking, what happened? I'm not making any money. Stock is actually moved in my direction. No, you didn't, because of the volatility impact. Because the vega itself is so high that a movement, small move in the implied volatility has a huge impact on your option position. So it is important to understand how the volatility impacts our options. And Vega will tell us, what's the amount of impact of volatility. But there were many surprises, especially in the meme stocks. I have seen the reverse case also. GME is at 300. And folks are thinking, oh, that is too high. It will come down. So let's buy a put. You bought a put. Great. GME came down to 250. Your put is not making any money, even though the stock has fallen down. Reason is the implied volatility also crushed. So all the benefit, the increase in put value because the stock has come down was negated by the decrease in volatility. In some cases, there were instances wherein the put actually was trading at a lower value at what you purchased. So even though the stock has moved hugely in your direction, you still didn't make any money on the put option that you bought because of the impact of volatility. So in these cases, if you see some weird behavior in options, try to look at what happened to the vol. That vol might be overpowering your stock movement. Okay. All right, looking at the Vega and days to expiration. Now, longer is the time for expiration, higher is the Vega for an option. This may be an eye test, so let me just pull up a trading platform. All right, let's look here. So this is a SPY. This is expiring 10 days. This option is expiring 24 days. This option is expiring 38 days. And the Vega is right here. On a Thinkorswim, you can just configure it to show you all the Greeks right up front. So for an option expiring 10 days later, the Vega is 0.28. Now coming to 24 days later, Vega is 0.44. Option which is 38 days later, Vega is 0.56. So if you are holding an option which is far down, more is the days to expiration, more is it is sensitive to changes in implied volatility. Now let's go back and see where, as a retail investors, what happens. So before that, let's look at its moneyness also. Not only Vega changes with the days to expiration, if we just look at only, say, 38 days to expiration, only one option. Let me increase the strike prices. In at the money, just like Theta, at the money options have higher Vega, 56, 55, and slowly it starts to decrease in both the directions, whether it is in the money or whether it is out of money. In both cases, the Vega is highest for at the money option and starts to decrease as we move away from at the money strike price. So how do we use this information? If you are taking longer days to expiration position, should be aware of volatility changes. Again, most of the people have no idea and don't focus on this one. And then you wonder why my option is not making money. And this becomes very apparent when you're taking a leap option positions. Leap means the options that are expiring more than 9 months later. Right? Many times we use leap as a substitution for stock. It's a capital efficient way to take longer positive delta positions. But now, because we understand Theta, because now we understand Vega, we need to figure out what's the right strike price should I pick up for leap. The most common, what I see among retail investors is buy at the money leap. Hey, Baba fell down $20 because of the Chinese government tech crackdown on tech companies. I think Baba will recover, will go higher later on. So let me buy the Baba option, which is expiring 10 months or a year down the later at the at the money option. But what you are doing, the mistake in that case is you're ignoring the impact of volatility. So remember, Baba fell down, its volatility would have increased a lot. And at the money options is more susceptible to changes in volatility. Even if Baba doesn't move, but the general volatility in the market comes down, even if the stock doesn't move, your options will lose value. So if you are doing leaps, you're kind of, and if you're doing ATM leaps, we are kind of picking up the worst of both worlds. Number one, the volatility has got a higher impact on a longer dated options. So if you're taking a leap, we are taking an option position which is impacted more by volatility. And number two, if you're doing an ATM at the money, of all the strike prices, it's at the money, which is more impacted by any other options. So the leaps are very sensitive to changes in implied volatility. So if you are trading a lot in leaps, be aware of it, and then determine what would you like to do. Of course, if I have to take a longer dated exposure, then I have to go and buy 9 months, 10 months. Now, maybe I don't have a time to pick up an options and buy 2 months out, every 2 months. So in that case, fine, you go ahead and buy 9 months or a year later leap, but understand that it is sensitive to volatility changes. So how do you mitigate some of the volatility changes? Is not by at the money. You could go and buy a little in the money or out of money. So those are the decisions you can make. Again, thinking about the impact of volatility on options. From an option seller side, I want to sell option when the volatility is higher than usual. Because higher the volatility, higher the premium. So say if I were to sell an option on Wells Fargo, I was getting bullish on Wells Fargo, say a week earlier. And now I'm looking at Wells Fargo and I know that it's going to report results tomorrow. I know it's going to report result on 14th of July morning. And maybe I would like to wait until 12th, 13th of July. The reason is as it gets in closer to the corporate event, the volatility is built up in the stock. Volatility means it tells us the uncertainty, right? IV is a measure of uncertainty. And for normal companies, this is a very uncertain event. Earnings call. We don't know. Could stock rise 5% after earnings? Could stock fall down 5% after earnings? We have no idea. And that is why closer to earnings, the implied volatility will generally increase. So if I was getting bullish at Wells Fargo and I wanted to sell a put a week earlier, now I know that Wells Fargo is going to announce results a week later. I might just hold myself and say, let me try to get a little higher premium, because the IV will increase. The implied volatility will increase in run up to an event, which is corporate earnings call. We have seen similar case. If it's a biotech company that you're interested in, the IV will increase when FDA is about to announce the results, or when their phase 3 trial results are coming out, because there's a lot of uncertainty built in that. Did it work? Did it have any better results than the existing drugs? We don't know. And that's why there's so much uncertainty. Wherever there's an uncertainty in the market, the implied volatility of that stock increases. So as an option seller, if I can, then I would like to wait until, I can get closer to an higher implied volatility environment, so that then I sell options, I can get paid better. And when the volatility comes down, the trade becomes profitable, because I sell option when the volatility is higher, you get paid more money. And when volatility after the earnings, now it's a public information. Everyone knows what happens to the to that company, in last 3 quarters. Then the volatility will decrease. Doesn't matter whether the stock has gone high or the stock has gone low after earnings. One thing which generally happens is your volatility will decrease. So from a Vega perspective, just as a retail investor, if you're working in a prop firm, if you're working in a hedge fund, you probably might have to dig a lot more. You might have to look at other aspects of Vega, which I am no way in a position to tell you. I'm a retail investor. But from a retail investor perspective, understand the volatility means higher option pricing, and understand the impact of Vega on leap options. One other concept around volatility is, when you're looking at volatility, it is relevant. It's a relative for each stock. For example, let's pick up IV. So in Think or Swim, you can look at what's the IV here. So SPY IV is 15.84. Now let's look at another stock. Fubo IV is 107. Now, does this mean Fubo is it's a great time? Or let's pick up Wells Fargo. Is it a great time to Wells Fargo has earnings tomorrow? Its IV is elevated. Anyway, so let's come back to Fubo. Is it it's a great time to sell option in Fubo right now, because its IV is 107%? You have to look at the relativity where the Fubo IV has been in past. If mostly in a past, Fubo's IV has been above 120, then this is definitely not a right time to sell an option in Fubo, because now it is lower than where it usually stays. So when you're looking at IV or volatility, look at the relative. And that's where the other concepts of IV rank and IV percentile come into picture, right? Outside the scope of this discussion. But when you're looking at a particular stock, look at where the IV is relative to where it has been over, let's say, past 1 year. Again, understand that longer is the days to expiration, more sensitive is your position to Vega or volatility changes, especially for retail investors buying leap is a very common trade among retail investors. I also do it. If I don't want to take a stock position just because of a capital efficiency perspective, I would rather buy leap. But then be aware that it is very sensitive to volatility changes. So maybe avoid buying leap when the IV is elevated or escalated in that particular stock. Let me look at a question. Okay, so Alonso asks, can we get the recorded session once it's over? So Alonso, all the boot camp sessions are recorded and it is available on the website. I think you maybe have joined later. So it's available on my website, optiongig.com, right from the drill 1 all the way till here. So you can go. It's available for free. Just register and get access to all the videos. Plus, there is a lot of other stuff as well. Okay. Any questions on Vega. Again, we don't have to get into analysis paralysis on Vega for as a retail investors. Okay, so I see one hand raised. Yeah, Abhay, go ahead with your question.
Can you hear me?
Yes.
Yeah. So question was, I wanted to ask basically is, so if option expiring worthless, then this volatility and gamma, the Vega and delta and all those doesn't matter much, correct? Then if it is going to expire worthless.
So if it expires, while it is reaching towards its expiration, these things do matter. And we'll talk about how gamma will impact you. But eventually, if it expires worthless, when it's at expiration, all your extrinsic value is already become zero.
Correct.
Right. So that you already reached the end of it. But while your options, let's say, are in last week of expiration, some of these things can actually change your option from being profitable to making a loss.
Yeah.
But once it has expired, then it is zero. Then the only thing that remains, the option becomes stock. So the option is over.
Correct.
Yeah.
So basically, if you want to buy and sell before it expired, then all these factors matters actually. Implied volatility and
yes. When we buy or sell, you will buy an option which is expiring 30 days, 60 days, depending on how long you want to trade. What's your comfort level? And during those days when the option is still active, all these factors come into play. And that's why your option pricing keeps on changing. Of course, stock is one thing. And I think everyone is aware of that. If my stock moves, my option pricing will move. But there have been instances wherein a stock has moved in your direction, but your option still hasn't benefited. In fact, it has lost money because of these other factors.
Yes. That's what happened actually. And I just wanted to understand. Now I'm understanding.
That's what happened in AMC, in GME. Yeah. I got pinged saying, I bought a put option, and GME has come down. Why am I losing money in that put option? I'm like, because your volatility has come down from 400% to 200%.
Yeah.
So your option has suddenly lost a lot of money because of the vol crush. Yeah. So that's why it is important to keep an eye on the Greeks.
Thanks.
All right. Okay. Any other questions on Greeks or on Vega? Okay. So this is the last one for today, which is gamma. So unlike delta, theta, and vega, gamma is a second order Greek. Okay. Not going to explain what a second order means, but the gamma will tell us how the delta itself changes. Right? So remember, delta tells us how the option pricing will change if a stock has changed. With one dollar move in the stock price, how your option price will change, that delta tells us. Now, gamma is actually going to tell us how the delta itself will change. That is why it is second order. It's not even talking about stock, the change in a stock. It's talking about a change in the delta. Delta is first order. It's talking about a change in the first order parameter. That is why it is called second order Greek. Now, there are third order Greeks as well. And there are, other second order Greeks. Voma, Vena. We're not going to talk about that. In my years of option trading as a retail investor, I never had to worry about where Voma is or where Vena is. So we'll ignore those second order Greeks. But one second order Greek that I have to keep in back of my mind is gamma. Now, just understand, if gamma is speed, if delta is the speed, gamma is acceleration. So when we're driving an automobile, on odometer, we get two types of readings, speed and acceleration. Everyone knows about speed, but acceleration will tell us how quickly the speed can change. And sometimes acceleration also becomes way more important. You know, speed is not enough. Sometimes the acceleration play a lot more role in driving, especially in case of racing. I see a hand up. So Abhay, you had a question?
I already asked.
Okay, sorry, I'll just lower the hand. So, okay. So, like I said, delta refers to how much the option value will change with $1 move in stock price. Gamma tells us how the delta itself will change with $1 change in stock price. Now, again, I don't go into much of analysis paralysis looking at the value of gamma. You know, when I'm looking at a portfolio level, few things which I definitely look at a portfolio level is where my overall delta is. Because as we learned in a previous session, it tells us a lot of things about our portfolio. Most important is the directional risk. So I know where my overall portfolio delta is. I also know what my overall portfolio theta is. But that tells me that if stock market closes tomorrow, all the stocks are frozen, so prices don't move at all, how much money I'm going to make? This is, you know, when you sell option, you can make money without the directional movement. So that's what theta tells me, that is there a way, or how much money can I make without depending on directional movement of the stock? That's what theta tells me. So I need to know, because if everything in my portfolio is coming out of whether stock is cooperating me or not, then I'm at the mercy of the market. I'm at the mercy of, if I'm a long position, stock going high, or if I'm a short position, then stock going low. But theta will tell me, you know, there is some portion of my portfolio which will make money outside of impact of stock movement, which is theta. Because I don't think we have a workable time machine yet. So time will always move forward. So if time moves forward, theta will decay. Now, gamma, I don't look at at a portfolio level on day-to-day basis. No. Focusing on those two will help me to keep my gamma in control anyway. So, but let's look at what gamma is. And you may or may not have to use it in your day-to-day decision making, some of this information. But because you're here, let's learn a little bit about it in case you want to go back and dig deeper into gamma. But I will definitely talk about the point that I use in everyday decision making, right? Again, the whole idea of learning what these Greeks is, okay, it's good to know what a theta is, what a vega is, but how do I make use of it in my investment decisions, or when I'm trying to open a trade, or when I'm trying to close a trade? That's way more important, right? So I've looked at it, theta. How do we make a decision? That's the reason why I open at 45 days to expiration. We looked at it on volatility, that if I'm looking at to do a leap, I know it is sensitive to volatility. So similarly, we look at how to make use of gamma in decision making. But prior to that, let's understand that long calls and long puts have positive gamma. Means if the stock goes higher, the delta will also increase. And short call and short puts have negative gamma. And we can look into a trading platform on this one. So positive gamma means delta will change in the same direction as a stock price movement. If you bought long call and the stock goes higher, the delta also goes higher. Oh, there's a duplicate of it. A negative means it will basically go in the reverse direction. But now this is the most important slide of everything around gamma. Closer you get to expiration, larger is the role that gamma plays. Oh, I know gamma means gamma it will power delta, it will tell me what's the rate of change of delta. But if gamma is not even playing much role while I'm in an option, then how do I care? And gamma actually start to show up at the party when the party is about to finish. So if I'm doing an option, I'm in an option party, which is going to go for 60 days. Mr. Gamma doesn't even appear. So we don't even feel its impact until it is getting closer to expiration. And that's the reason you would see me talking about, it's time to start closing our positions, because now we're getting closer to expiration and the gamma will be showing up in the party. So as you get closer and closer to expiration, the role of gamma starts to increase. That means if the gamma becomes bigger and bigger, it means there will be a rapid change in the delta of your options. So Abhay had asked a question, if it gets closer to closer, near expiration, will the impact be going zero? No, the delta will be becoming much bigger. Its impact will be becoming more and more. You will feel its impact more on your options as you get closer to expiration. That means, okay, here's some illustration on this particular is 10 days out. Let's go back to SPY here. So let's look at a gamma on 10 days out. Whereas gamma is 0.05. Let's look at 38 days out, 0.02. Mr. Gamma isn't even showing up at the party. We are looking at the same strike price. So if I'm dealing with an option, whether if I sold or bought an option, I don't care. If I bought 435 strike price, but of 20th August, Mr. Gamma doesn't play a big role yet. Or if I go further down, it's even lesser. Of course, there are other things that come into picture, but Mr. Gamma doesn't play a big role yet. So this is the graph, again done by Tasty Trade, but this tells us visually very telling graph, which tells us how the gamma starts to increase. So till 30 days, 21 days. So these are at your x-axis. Horizontal axis is your days to expiration. This is where our options expire. And here you might have a 45 days to expiration, 30 days to expiration, 31 days to expiration, 21 days to expiration. So as you can see, the gamma starts to increase as you get closer and closer to expiration. And in last week of expiration, the gamma will be super high. So what gamma does? It tells us how your delta itself will change, right? And delta is how your option pricing changes with $1 movement in stock. So it means you are getting closer to finish line, and say the stock has moved a little bit, and suddenly your option trade has moved from being profitable to a losing trade because of the impact of gamma. If the stock had done the similar amount of movement, say stock, you were bullish on it, and stock had gone down by $1. If it had gone down by $1 here when it was 31 days to expiration, you probably wouldn't have noticed its impact on your option pricing. But if it had gone down by $1 closer to expiration, just because the gamma is so high, it will change your option pricing by a lot more amount. You will feel its impact a lot more. So that is one. So the decision making that I do, how I use it is I try to close my positions or manage my positions when I'm getting closer to 20 days to expiration. That is why I pick up 20 days to expiration. Why even take a chance with gamma? Or if I can't do, and again, that's a guideline. It's not that I'll be done, I won't have any positions which has got less than 20 days to expiration. I'll have sometimes position which is, till the last week. But then I know that those positions are kind of sitting on a live wire. They're sitting on a tight rope. A little bit shaking here and there, and my position could move a lot. That's the understanding that I think we need to have. That's the takeaway from a gamma perspective. Forget about the gamma is 0.01 or 0.02. But the fact that the Mr. Gamma will show up at the party closer to expiration, it means if you have positions which are very near to expiration, make sure you're watching them closely. And then as a retail investor, that is why I don't deal in weekly options. We don't have a time. You might be in a meeting and the stock moves, boom, your profitable position could have gone to a losing position. That's the reason why I don't do weeklies. I don't have a time to monitor it. Or if I have done, trade which was like 45, 50 days to expiration, haven't yet become profitable, and I'm trying to look at it and it survives till the last week, then I'm watching it with binoculars. Okay, guys. And if by the time it makes any money, I'm out. I don't want to do a penny pinching when it is the last week of expiration. So again, from a retail investor perspective, where you got your own automated systems, like a prop firm, you have your algos running, probably then they'll take care of it. But for a retail investors, that is why I don't deal in weekly options, even though the theta decay is maximum in the last week. But because of the gamma stuff, I don't want to take that big chance of huge volatility in my P&L because of gamma in the last 1 week of expiration. So that is, as an option seller, or I would say this also goes to buyer as well, because your option premium will change. Just avoid burning by gamma rays. Get out of the trade, get out of the party before gamma shows up. And if you're not, then just be aware that position which is profitable right now, if it is at the money, it is even more susceptible to gamma. And if you're making little amount of a profit, not what you generally want to make, but it's little less than your profit target, no problem, get out before the gamma actually hurts you. Because it could. If the stock goes against you tomorrow, you didn't take out your profitable position today, stock moves against you a little bit, your option might move a lot more, move from a profitable to a losing position. So that's a decision-making factor around gamma, is try to get out of position before the last week. Generally, we have a profit target. If I'm selling this option A, I might want to make, because I'm selling it, I know what's the maximum I can make. And I'll generally try to get out of it when I'm making 50 to 60% of it. Because to make 90% of maximum, I'll have to wait till last week of expiration. And that's what I don't want to do it. But there are cases wherein, market has not cooperated. Stock has gone way against us. In that case, I might carry this position in the last week, but then I'm aware of the gamma risk that exists in that position. So best is to get out, but market is not always in your favor. That's why we use options. That's why we know how to manage options. We learn option management techniques. And don't be cute or greedy in the last week of our expiration. I just had yesterday, I think we sent an alert around on trade on IBB. I in fact took a small loss on that trade because we made profit on another IBB, which is biotech ETF. We made decent amount of profit on another one. This was challenging me. And yesterday, it was at a position where it was at a lesser loss. So I'm like, okay, we are in the last week for July 16th. I'm taking that small loss and moving out. I don't want to be greedy. Sometimes it may not work because today it actually fell more down. I was thinking, oh, if I had not closed it yesterday, I could have got some $20 profit rather than making $70 loss. But over a longer period of time, I've seen that it has saved my behind. I have made money and I've realized that if in the last week I would have carried it on to the last week, I would not have made that money, which I did because I closed it sooner. So no need to be greedy in the last week. Even if you are making way less than your profit target, fine. If you still have that same outlook on the stock, close this one, put for a new expiration. That is equivalent to shutting down this party and moving into a party which has just started. And we know that Mr. Gamma won't show up there for another 20, 30 days. Yeah, because your profits can evaporate quickly because of gamma changes in the last week. So that's all about gamma. Now I see one question, so let me address that one. So say I made some money for a call option that expired the 16th. You won't get greedy and sell until 15th just to see it recovers small profit. So because you have sold, I don't know in this case, whether you have bought a call option or you have sold a call option. So if you bought a call option, your loss is already limited. Maximum is limited to the amount of the premium that you have paid. In that case, you already know what your max loss could be. And if you want to, if you're okay with that max loss, you might just hold it. But all the decision, because we are selling options where the loss is undetermined. And that is why we take the decisions and avoid the gamma. So but let's say if your call option is already making money right now, and you're hoping that maybe, if I hold it and it'll go higher, it will make more money, fine. But if it goes lower, it will lose money also quickly because of the gamma. But if you're buying an option, your maximum risk is anyway limited. You know what the max risk is. Hopefully, Alonso, that answers your question. If not, to let me know if you want to ask again. I hope I got the context correctly. Okay. I see one more question. All right, go ahead, Abhay.
Can you hear me?
Yes.
So, in the same regard, you're saying is buy and sell options. So how about buy, I understand we have the person user knows, was the premium you paid and all those things are defined on the other side. But what about if I had the put spread? That also the defined risk.
Yeah. Yeah. Again, put spread. Let's go back to our trade management sessions. I generally don't manage the defined risk positions because I know how much is the maximum I'm going to lose. Number two, because the spread has got one long and one short position, the impact of, let's say, gamma kind of a cancel out. So, but I think for me, more important is because I know maximum what I can lose. And if I was not okay with that trade, I wouldn't have even done that put spread to begin with. So generally, that's why for a spreads are very difficult to manage. You don't get much of a leeway when you're trying to manage the spreads. You get a lot of leeway and optionality you have available when you're trying to manage naked positions. But spreads, tough to manage.
Okay.
All right. Okay, any other questions? Yeah, this is the last slide for today. Probably we'll finish up earlier than usual to compensate for all the times that I've kept you over time. Maybe we'll finish today early. So a quick takeaways, a quick summary. Theta is a decay in option price just because the clock always moves forward. Just because time will pass, this too shall pass. So that's what theta tells us, how much your option premium decay will happen just because the calendar has moved forward by 1 day. Okay? That's the theta decay. It's a friend of option seller because we want to sell an option and then we want that option to go down in price. Okay? But it's a nemesis for option buyer because that's a hurdle that as an option buyer, you have to jump across, right? So for example, if your theta, let's say theta stays constant at 0.25. If you bought an option today at $2 and theta is 0.25, then tomorrow that option is going to be worth 1.75. Then later on, it will be worth 1.50 just because of theta impact. Then we are praying that maybe stock should move quickly so that it compensates for the decay in theta. Because we're completely dependent on the stock movement on which we have no control. At the money has highest theta. So if you are buying at the money options, you understand that you're impacted by a quick decay because of theta. But if I'm an option seller, that's a great thing for me. That's what the straddle brings a lot more premium. But the other risk is it's also higher delta. So again, that's why there's always a risk and reward. Selling an at the money option brings us the most premium, but also brings us the most directional risk because it's got a higher deltas. That is why I generally prefer 30 delta option, 25 delta option, and not at the money. Vega, the other Greek, is change in option price with change in volatility. Again, from a day-to-day decision-making perspective is longer days to expiration, higher Vega. So if you're buying leap, understand that it's impacted more by change in volatility. So if you had bought a long call option, stock has gone up, but the vol has decreased a lot. Your shorter duration long call option may become more profitable than your longer duration long call option because that is more impacted by Vega. Because of ATM and the longer duration, it's got a huge impact on ATM leaps. Finally, gamma is a rate of change of delta. It's the delta of delta. And just get out of the party before gamma shows up. And if you can't get out of the party, understand that gamma is here, it's lurking, and it will show up its impact if the stock goes against your directional outlook of your option trade. So considering all this, when we are doing an option trading and taking a decision on it, theta, 45 days to expiration, because the theta decay is not linear. If I sell an option which is 120 days out, I don't get paid much. It will decay very slowly. If I sell it very closer, I get impacted by gamma rays. That's why we pick up around 45 days, 50 days, 60 days is also fine. Vega or volatility, higher volatility, higher the option premium. And gamma, with gamma will make your option pricing or P&L change a lot, which I don't want, because I want little predictability. I don't want my P&L to be jumping all over the place because of Vega or because of gamma. That is why I would like to close as many trades as possible before, within 3 weeks of expiration. Even if it has not hit my profit target, it's okay. I made some money, no need to be greedy. Let's put the same trade for a longer dated option so that I can remove the impact of gamma. So that's all for today. Let me look at some more questions. Carolina asked, can you talk about a row a bit? So row tells us, I'm sorry, I have no slides for row because I never use row for my general trading. But row tells us the impact on option pricing if the risk-free interest rate changes. The reason why, at least in the US, we not been talking about row much as a retail investor is Fed doesn't change the rate of interests. First of all, the rate of interest are already very low. Number two, they don't change much. One area where the row could have an impact is again on leap options, right? If I buy it 2 year down leap. Now let's look at, some stocks have, Apple probably will have a leap all the way to 2023. Yeah, 16 June 2023, almost 2 years down. Now this may get impacted by row. Because now your risk-free interest rate will change, and hence the option pricing, because that also is one factor in determining an option pricing. Most of my trades, 90% of my trades, I would say 95%, is within 60 days to expiration. I don't have to worry about interest rate changes at such a shorter duration, and that's the reason why I haven't made use of row much in my in decision making around my option trades. You're welcome, Carolyn. Another question from Alonso: is trading volume average of the stock more indicative of how the option will perform over the Greek indicators? Nope. So the trading average, and let me make sure, Alonso, if I got this right, you're asking for this, the volume, right? Today, 100 million of Apple shares have been traded. This is a decision-making factor when I'm trying to open an option trade, specifically because option seller. When I'm trying to open an option trade, I want to trade in tickers which are liquid. Right? I don't want to trade in a ticker where only 20,000 shares have been traded, because I won't get good pricing. So when I look at a volume, that's my decision-making factor for entering a trade. It means Apple is pretty liquid. There's a tight bid and ask spread. On a stock, there is a 5 cent difference or slippage between bid and ask. Look at an options, at the money options. This is the options right now, the pricing is not correct because of the after hours. Generally, if you look at an Apple, it will be 1 cent or 2 cents. It's a very tight market in highly liquid stocks, but it doesn't tell us how the option will perform. It will tell the way this comes to decision-making factor. Say the slippage is, if I bought or if I sold an option and I change my mind. So when I sell an option, I have to sell it at a bid price. And say I change my mind immediately. Stock hasn't moved anywhere and I want to buy it back. I just lose the money because the ask is higher than the bid. If it's a tight market, it's a penny white, 2 penny whites, the amount of money I will lose just by changing decisions very less. That's called a slippage. But how the option will perform, that's got not much bearing on how much volume has been traded. All right, then let's call it a night right here. Thank you, everyone. And I'll talk again with you on Saturday or on next Tuesday.